every one of these is a little unreliable. You can see that fast growth, the pale blue, the medium blue and the dark blue, those two bands that go across the top, those are cheap stocks. And cheap stocks have been awful for the last 15 years. All right, well, that's well known. The turquoise is fast growth and expensive. That's been brilliant for the last 15 years. But if you go back to the dawn of our data, going back 57 years, what you find is that each of these three categories, fast growth and cheap, fast growth and expensive, and slow growth and cheap, have beat the broad market. The real standout, and each of them has had a period in the sun. Each of them has had a period where it worked beautifully. Each of them has had a period in the doghouse. Look at the medium blue, which is slow growth and cheap during the dot-com bubble. You can see that that tumbles almost in half in just 2 years. Slow growth and cheap did terribly in the dot-com bubble. Slow growth and cheap did terribly in the run-up to the COVID value meltdown. So value, fast growth and cheap and slow growth and cheap, both of those tumbled sharply in the latter half of the 2010s, right on up to the trough of the value crash in summer of 2020. But basically what you can see is each of these has a period where it's the best place to be. What was the period where it was the best place to be if you wanted to invest in slow growth and expensive? Well, it was about 1984 to 1992. That's it. That's the only time in a 57-year history where slow growth and cheap beat other strategies. My goodness. This is to be avoided. And so our point is dividing stocks into growth and value and saying all stocks fit into both buckets, and some stocks fit into both buckets, is simply wrong. If you choose growth stocks based on their growth rate, you just do better.